The first rule of investing is don't lose. And the second one is, don't forget the first rule, and that's all the rules there are. I mean, if you buy things for far below what they're worth, and you buy a group of them, you basically don't lose money. Warren Buffett is reportedly worth over $100 billion. From a shy boy selling Coca-Cola door to door, to molding Berkshire Hathaway into a billion-dollar empire, the Oracle of Omaha has remained as one of the richest men in the world. But what makes him so unique among the wealthy is that he didn't inherit his fortune, nor did he acquire it by innovating technology, but rather, he grew his wealth by winning consistently in this stock market. So how did he do it? What did he do differently where so many others have failed? In this video, we're going to learn how Warren Buffett beat the stock market and became a self-made investment billionaire there, starting from the very beginning. Warren Buffett was born in Omaha, Nebraska in August of 1930, just 1 year after the Great Depression hit the country.
And the overinflated stock market plunges into a Great Depression.
In his early childhood, he noticed how people struggled to make a living due to the severe economic crisis and quickly learned about the importance of money. Luckily, his father was a smart businessman, and although he had recently lost his job from a local bank, he used what little savings he had to open his own company selling stocks and bonds, and from this, was able to provide enough for his family. Eager to put his new knowledge to use, he approached his grandfather, who owned a local grocery store, and asked him if he could provide Warren with drinks so that he could go and sell them around the neighborhood. His grandfather agreed, and so at the young age of 6, Warren started his first business selling Coca-Cola door-to-door and making 5 cents for every 6-pack. He soon added a few more items to his small business, and just a year later, Warren was selling chewing gum, magazines, and Coca-Cola while making a decent profit for himself. By the time he was just 11, the boy used all of his savings to buy his first stock, purchasing 3 shares for himself in an oil and gas company called City Service, with each stock valued at $38. But shortly after buying them, their value dropped to around $27 per share. Despite the anxiety he felt, he held on tight and waited until their value rose to $40 before selling them. Although he had successfully turned a profit, he noticed that those same shares later shot up to over $200. The news of his missed opportunity stung, but it taught him an important lesson. 75 years have gone by, and he has never known what the market is going to do the next day. That's not his game. Buffett's game is to decide whether he's in the right economy and by owning good companies for long periods of time. Fast forward to Warren Buffett's 30s, and he founded an investment firm called Berkshire Hathaway. Under the pressure to outperform, Buffett does the unthinkable. He invests in a Wall Street firm, the Salomon Brothers. Buffett thought to himself, this could be a good company to invest in. Salomon Brothers started as a bond trader in 1910 and came to prominence during the Roaring Twenties. In 1985, the firm made a profit of $500 million, establishing its position as one of Wall Street's most profitable companies. Warren Buffett sees Salomon Brothers as a great business, with an excellent management team in place. Despite this, he believes the company is overvalued, but the Oracle of Omaha still manages to find a way to profit from the situation. He presents Salomon with a proposal. If they want his money, they must create a security for him that guarantees a 15% return. You see what he did there? Buffett was leveraging his brand in exchange for a riskless profit. For Salomon Brothers, having Buffett as an investor is a huge boost of confidence for the company's stock. They managed to create a preferred stock that is designed specifically for him. This security would generate 15% return for Buffett in the long run, but with an unlimited upside should Salomon's stock soar, and Buffett buys $700 million of them. On October 19, 1987, the world watches in shock as the stock market crashed in what became known as Black Monday, with billions of dollars evaporated. Buffett watches as Salomon Brothers begins to crumble. For the first time, he starts to worry that a bankruptcy of Salomon is becoming likely. But the crash also presents an opportunity for Buffett to invest in a company that he has been watching for a while, Coca-Cola. For many months, Buffett was buying as much Coca-Cola as he could, roughly a third of the volume trading. Every day for months, Buffett was very aggressive in buying into Coca-Cola.
I like this one.
Warren Buffett continues to leverage his unique brand to get special deals from companies, such as Gillette, where he obtained a 9% preferred stock. As the shares of Salomon Brothers make a remarkable recovery following the Black Monday, Warren Buffett thinks the worst is behind him. Little does he know, the storm is far from over. When bond trader Paul Moser is found out manipulated a treasury auction to make a huge profit, Salomon Brothers' reputation is severely damaged. In finance, losing reputation means losing confidence. Within weeks, the company is on the verge of bankruptcy. Salomon Brothers is under investigation by the Treasury Department, the Federal Reserve, the SEC, and the Justice Department. But more important than the fate of the firm itself is the impact their actions could have on the public trust and on the credibility of the American market worldwide. And a CEO is desperate to restore the public's trust. He is hoping there's one man that can help boost the confidence of the market. And if he says Salomon Brothers is fine, maybe other investors will follow. Buffett is called upon to save Salomon Brothers, but instead of engaging in a legal battle, Buffett takes a completely different approach. He turns Salomon Brothers inside out, making the company completely transparent to the lawmakers and giving prosecutors access to any and all documents. Buffett knows this may be the only way to prevent Salomon Brothers from going bankrupt. But it's more important that he preserves his own reputation. And to do that, he needs to be on the side of the people, fighting corporate greed. Buffett's crusade to eradicate any bad apples in the company results in Salomon Brothers being reduced in size and many employees lose their jobs. And more importantly, Buffett's investment in Salomon Brothers remains intact. With the salvation of Salomon Brothers, Buffett's business soared, making him the richest man in America. And with that momentum, he buys the rest of Geico as insurance companies continue to be his biggest cash cows. After all, Buffett's #1 role is to never lose money. And the $700 million bet is a quarter of Berkshire Hathaway's entire portfolio at the time. But we'll see that Buffett learns a valuable lesson. Fueled by technological innovation and globalization, the mid-1990s in America were a time of a great economic growth. For the newly crowned America's richest man, it's not necessarily good news. An overheated stock market means fewer investment opportunities. But Buffett ultimately succumbed to the pressure and temptation to invest. He acquires a giant insurance company called General Re for $22 billion. He paid for it using Berkshire Hathaway's stock is something Buffett has never done before. Buying something with stocks could be interpreted that Warren Buffett thought Berkshire Hathaway was too inflated. But buying the company during the height of the dot-com bubble is going to be a mistake that Buffett comes to regret. Amidst the turmoil of a scandal that sent Coca-Cola shares plummeting, Warren Buffett's recently acquired company General Re also faces a disaster of his own. In 1999, the company was defrauded out of a staggering $275 million, jeopardizing Buffett's investment and threatening to undermine his reputation as one of the world's most successful investors. As the boat market charges ahead, producing new millionaires at a breakneck pace, Warren Buffett's legendary investment record appears increasingly ordinary. To make matters worse, Buffett's personal life takes a dark turn. In early 2000, Buffett finds a tumor in his colon and is hospitalized for surgery.
The billionaire investor writing a letter to Berkshire Hathaway shareholders, Buffett insists his condition is not life-threatening.
While Buffett recovers from the surgery, the stock market takes a nosedive and a dot-com bubble finally bursts. After what they are already calling Black Friday, it was the worst single-day point loss ever. After the dot-com bubble, Buffett's reputation revives. He's not ready to re-enter the game and start scouting for companies selling at a discount. But there's a problem. Less than 2 years after the dot-com bubble, another major disaster hits American finance industry. As the housing crisis deepens, Wall Street's once impregnable fortress begins to crumble. One of the industry's most legendary firms suddenly finds itself on the precipice of ruin. Desperate to restore confidence in the market and fend off financial disaster, Goldman Sachs turns to Warren Buffett. While billing out Goldman Sachs, Buffett makes sure he gets a favorable deal from the bank. That guarantees him a huge profit once the firm survives the crash. He employs the same strategy with the General Electric, investing $3 billion in preferred stock that offers unlimited upside and no downside. 2008 was one of the best periods of time for Warren Buffett. He invested in a lot of troubled companies and even in distressed debts. Berkshire Hathaway was so invested that he ran out of cash for the first time ever, while the housing crisis of 2008 becomes a thing of the past. The American economy has seen a remarkable resurgence, with the market experiencing one of the longest periods of prosperity.
We have 75 million houses, and we had a few huts then, and that train is going to get derailed.
The shares of Berkshire Hathaway have soared to incredible heights. In 2016, his attention was drawn to an unexpected company, Apple, a long-standing avoided investment for Buffett. Warren Buffett's Berkshire Hathaway has taken in a $1 billion stake in Apple. Despite his large investments in behemoth companies like Apple, Berkshire Hathaway's stock price remains stagnant. If you look at Berkshire Hathaway's stock price for the past 15 years until 2022, it behaved very similarly to the S&P 500. For the past 5 years, Buffett has been content to sitting on the sidelines and observe the market's unprecedented boom driven by retail investors and cryptocurrencies. But after years of going through market cycles, Buffett and Munger are convinced that the time will come for the market to fall.